Hey everybody, Brian here from quantlabs.net. Okay, so moving on with selling commodities. Different than a hedger, we're going to work on a third strategy, selling call options. The idea here is we sell a maximum selling price, call option with a strike price, plus the premium received, plus or minus the expected basis. Now, that will give you your max expected basis. But when you look at this table here, what you'll find is you'll get different future prices for the basis if it stays the same. The cash price, which is calculated by futures minus the basis. The cash price, but here's where it gets kind of tricky. When you get a net selling price up to a maximum of 1176 in this case, which is calculated as the max ceiling price, we get a different short future profit or loss. So when you hit the near maximum, you'll get a penny or 49 cents depending upon what's happening in the basis and the futures. Also, if it's less than, the net selling price is less than, or what would become the net selling price is less than the max selling price, cash price plus the premium, but up to a max on your max ceiling price. So let me show you the code here. So we got our typical structures we've always had, future cash, short, future change, which is really the gain or loss, and the selling max ceiling price. That's the net selling price. So what we need to first do is, as an example here, and as in this document, we set our selling price using that formula, the strike plus the premium minus the basis. On top of that, we just output that out, which is right here. So this is our ceiling selling price of 1176. Now, as you know, we're just going to feed in some future data. On top of that, we've got to set our array length size of the contract, of the structure, C. And then what we do is we loop through that all the different conditions. So first we calculate our cash price by taking the contract's future price minus the basis. We've got the cash price minus the premium, but as long as it's not greater than the max ceiling sell price, we set the sell price being cash plus the premium, the short future change, which is really the premium, and then we just output the ceiling of the cash plus the premium. Now, if it's the difference between the cash and the premium is equal or greater than the ceiling price, we set the sell price equal to the ceiling price, right? Short futures change, gain or loss, is equal to the selling price minus the cash price. And then, of course, our ceiling sell price is the same as what we said. That's the max ceiling price. And we just output it out. Okay, so let me just run it. And I can verify that this does match with this right here. So there you go. Now that's the third strategy. And this strategy, I forgot to mention, would help if I do that, is under the condition when you want to sell call option to increase your selling price in a stable market. So if you expect your selling price to increase, you use this strategy. Hopefully it'll help you out.